This video is presented by VoiceOver article. If there's one reality that should be accepted by mortgage borrower, that is the fact that mortgage interest rates nowadays are soaring unrelentingly. Consequently, the used to be lustrous adjustable rate mortgages was already outshined by the conventional fixed interest loans for mortgage. In the event that you decide to take mortgage refinancing and have a foreseeable mortgage payment, you would need to work out your budget. Probably you may take the 30-year fixed interest rate mortgage loan, but it should be paired up with enough knowledge regarding mortgage refinancing so that you won't end up outspending. Be informed. Knowledge is the key for you to be able to direct everything to a path that is lucrative for you. Yes, it's popular and for some it is the best option to take, but are you guaranteed that it would function in the same way with you? The first step for you to take to be able to calculate the risk of what you are settling in, is to investigate the existing market and some accessible services which you can take advantage of. The benefits. If you are a homeowner with an untarnished credit, then you might just be looking at a blessing thrown from heaven, because you can experience having lower rates than what the others with bad credit has to endure. Not to mention the fact that you get high appreciation for your property. Refinancing may also be beneficial for you, as soon as you reach the moment known as the reassessment phase, wherein the payment, terms and the interest rates would most likely be altered at that point. The hybrid loans, which are especially offered by mortgage refinancing, gives you a fixed rate while choosing from an adjustable rate of the so-called balloon payment, which is characterized by balanced due. This option may actually give you either gains or costs, but for you to be able to weigh which is the best option, then you must learn to conduct a basic comparison. Simply evaluate the costs, the loan where you are in as of the moment, and a potential loan which you are taking into consideration for future action. Due to the fact that you can only estimate how much you are going to pay subject to your capacity to pay, you can only predict the length of time when you would be able to handle a new mortgage. If you were able to sum up all the costs and it is lower than what you currently, then you must refinance. How much to borrow? Though it is the discretion of the lending agency to provide you with the amount of refinancing loan which you have applied for, but there are times when they would just give you less. They are most likely to consider your capacity to pay them back, your credit history, previous monetary responsibility and the appraisal of your home. In reality, the advantages offered by refinancing were really amazing, but for you to be able to maximize it, you must also gauge the perfect timing when to settle for it. This video is presented by VoiceOver article.